Welcome back. In this segment, we're going to continue our look at dividend policies. And in particular, we're going to look at some of the practical things that businesses do. One way that businesses set their dividend policy is to say, I'm going to pay out a constant percent of my net income. That gives the business some planning and some flexibility. When times are good, they pay out more dividends. It's a percent of the net income. So net income goes up, the dollar amount goes up. But if I have bad times and my net income is going down, well, I pay out less. So the investor doesn't see a constant dollar amount. The dollar amount can go up and down. On the other hand, many businesses, I would argue most, when they pay dividends, do a stable dollar policy. In this one, they decide that they're going to pay out so much per share, what my dollar amount per share is going to be. And that tends to be relatively stable. They try not to change that, but they might. They might increase it if they view the future outlooks as being good, or they might decrease it if they have uncertainty about the future. And the board of directors will look at this and change only when they think it's the right thing to do based upon their future outlook. Sometimes people pay small regular dividend each quarter, and then they pay something at the end of the year. That way they are covering themselves in case they have bad times, and they don't have to pay that extra at the end of the year. Or they may have good times and they can pay extra, a little more at the end of the year. So that's another way to kind of cover a business's risk, is don't spend it all during the year, but leave some in reserve for the end of the year. And there's also the case where there's a one-time, sometimes people call this extraordinary dividend payout. Business might have a lot of money, and they say, okay, we need to draw down our cash, and so we will pay an extraordinary dividend, one-time payment. And it's announced that way so that investors don't expect it to be an ongoing thing. Now, there's things called stock dividends and stock splits. A stock dividend is not really giving out money. It's giving out more shares of stock. Now, let's suppose they might give out 1 share of stock for every 2 shares of stock you own. You could do that as a stock dividend. Notice I'm not giving out cash, I'm just awarding new shares of stock. That's a little different than a stock split, where you exchange your existing shares and you get new shares. That would be a stock split. And no pun intended, but it's kind of like splitting hairs. It's basically something that accountants will argue over, but for investors, it's basically the same. I start with a certain number of shares and I get more shares. Well, there's no money involved. Why would companies do that? One reason, and this used to be a very common reason, is to keep the stock price in a relatively low trading range. If the stock price went up to $100, maybe people couldn't afford to buy many shares of stock. So you might split it 2 for 1 or give a dividend, a stock dividend. And that might, if it was a 2 for 1 split, then I would have twice as many shares, and you'd expect the stock price to drop in half. Okay, so it went from 100 to 50. Now more people could buy the stock. That used to be the case. Now with mutual funds and electronic trading and things, people don't typically buy in what's called 100 share lots. People buy in odd lots, less than 100 shares. So it's not as big a deal as it used to be. And you'll see companies like Berkshire Hathaway have very, very high stock prices. They don't care about that stuff. And most companies these days, I don't think, care that much about it. It's not as big a deal as it used to be. And you might do that also because you're going to signal information. hey, we think we're going to do well, so we want more investors out there and more stocks. Don't hear that as much. In fact, you don't see very much stock splits and dividends nearly as much as you used to. Now, a topic that is huge in the news are stock repurchases. This is because 2 years ago we had cut corporate tax rates. And what happened was businesses used that extra cash to buy back their stock. And now we've just had a $2 trillion bailout of large firms and a condition of taking money from that bailout. Businesses have to agree not to repurchase their stock. Why? Why does a firm buy back its stock? Well, if I buy it back, then there's less shares on the market. Okay, so what? I had to spend cash. But if there's less shares in my company, then my profit per share goes up. My earnings per share goes up. Why? Because there's less shares of stock. My return on equity, the return on the owner's investment goes up. Why? Because there's less equity. So the profitability ratios go up. What happened? I have more leverage. When I buy back stock, that means instantly I have more bonds relative to stocks. Now, this is the major reason that people do this in terms of increase their leverage. I want to make money using other people's money. Sometimes you hear about stock buybacks because people own fractional shares. Companies allow people to reinvest their dividends and buy shares of stock, and sometimes you get 2.54 shares of stock. Well, it used to be people wanted to get rid of the accounting of those fractional shares, and so they would buy back those fractional shares. Regardless, when you buy back the stock, there's less stock out there. The earnings per share are greater. The return on equity is greater, so the stock price is going to go up. That's another way of giving money back to the owners. Their stock price goes up. And money goes back to the owners without them having to pay taxes, because it's all going to be future capital gains. So my stock price is going up. I'm going to get the money in the future. Not a problem. So question arises, I got all this extra money. What should I do? Do I want to pay dividends or repurchase shares? It kind of depends upon the business, what the business wants to do. Am I looking to do leverage? Do I want that long-term capital gain? Or do I want to cash now? Notice that Apple actually has done both. It had so much cash now, it had to give it back to the owners. And it also, at the same time, went out and borrowed more money to increase the leverage. All right, so these are the kinds of things that the financial people will look at inside a business. This is not an accounting thing, but more a corporate finance thing. How do I finance the business? Where does the money come from? How do I leverage myself? What's my capital structure? And those sorts of things.